let's start off with you, Dr. Ross. What are you looking at nowadays? What is the most interesting thing, and what piece of advice, not financial advice, just piece of advice, friendly advice, would you give to anybody heading into the next 6 to 12 months?
Whew, that's a good question. Well, I think anybody who's been paying attention at all realizes that something is up, right? When you see banks collapse, that's not normal. When you see, people talking about recession and people starting to panic a little bit, none of this is normal. This is kind of the downside of these asset bubbles that get inflated. Now we're seeing them get deflated and downright pop. That can make life difficult for people. And so I would just challenge people to, really think hard about how you can protect yourself and your family and your purchasing power in the near term, in the coming year. If we have a tumultuous coming year, if the economy gets really rough, if people start losing their jobs, man, do everything you can to keep your job, keep your head down. I would strongly recommend considering to figure out what makes Bitcoin, and I would even throw gold in there if you want to, especially for older folks. What makes those different? Why do we call those hard money? What's different about Bitcoin compared to government fiat? And if fiat is basically programmed to take your purchasing power methodically year over year, what are some ways that you can actually preserve your purchasing power? It's different for everybody. I come from the finance industry, so I grew up talking about stocks and bonds and thinking about things like that and real estate and whatnot. But there is a kind of money that literally was designed to not only protect but appreciate your purchasing power over time. And so I would consider looking into that and taking the time to learn a little bit more about Bitcoin, especially over the coming 6 to 12 months.
And thank you, Dr. Ross. And same question to you, Joe. Is there any indicators or anything that is on your radar that you're looking at? Is it the unemployment rate? What are you looking at? And what piece of advice would you give to friendly advice, not financial advice, to anybody watching the show heading into the next 6 to 12 months?
Well, thanks again for having me on. What I'll say is this. Let me give you two things just to look at in terms of the broader crypto landscape. So I still think you're going to see a series of new enforcement actions filed. We've only seen the tip of the iceberg over the next, say, 90 to 120 days, most notably the Coinbase filing. When you get that filing, okay, and when it comes out, scroll to the end, and there's something called the prayer for relief. And before you read the bad news articles about, legal journalism and whatnot, read the prayer for relief in that complaint that's filed by the SEC. See how broad it is. See if it seeks an order asking Coinbase to suspend their exchange or suspend the trade of certain assets. That's going to be huge. I mean, that could be an existential threat for Coinbase and every other public exchange in the United States. So that's really key. It's probably the biggest story in quote unquote crypto as we move forward. But for the economy, okay, which is I think what you're trying to get mostly at with your question. The two things that I'm looking at, again, continue to be the credit markets. I still have seen, the spreads hold up reasonably well. I expect those to blow out at some point this summer as we get closer to a recession. I think unemployment will be the last thing that really gets to accelerate. First, there's a sequence of all this. First is the credit deterioration. And once the credit deteriorates, then companies which are starved of that credit, then they have to start letting go of workers. And I think because of shortages in the labor market and the fear of not having workers, they're going to prolong people on the payrolls for much longer than they probably should. They're going to err on the side of keeping people unemployed probably until the later part of this year. But those credit spreads are key. Any metric you want to look at, it'll all tell you the same story. Look at those private credit spreads, particularly at the high yield end. And then the other thing, which I think is far more leading and important to look at, is look at some of the commodity prices. Look at the action in copper and oil. And if you noted today, what everybody's talking about, the banks and the regional bank blow up. To me, what was far more interesting is what's going on with the XLE, which is the energy sector ETF, and also the price of oil, right? You will recall a few weeks back, I think it was, the Saudis announced those production cuts, and they were trying to shore up the oil market to say, listen, we need to make sure we maintain price stability. It popped, and then went straight down, right? It's been a free fall selling mode, which oil is so important. It's the lifeblood of our economy, and it's not bullish that oil is selling off like that, right? If we were entering a new growth cycle, if China reopening was going to propel us to a long-term economic growth period for the next 2 years, you would not see oil performing like it is right now. So if you want to pull those things up, high yield spreads, oil, copper, they'll tell you the signal in far before the stock market or the S&P 500, which isn't particularly meaningful on economic growth.